Fears that the Amazon effect would kill the retail sector now seem to be overblown. Despite a majority of consumers switching to online shopping over brick and mortar stores, retail giants are adjusting by offering more online options and revamping their stores. These new retail environments proving successful for stores like Target, Walmart, JCPenney, and Nordstrom, all seeing growth in recent earnings reports. Let's take it to our markets panel. Invest Market Advisory Group Principal Michael Lee and Stock Swoosh owner Melissa Armo. Melissa, I want to ask you first about retail specifically. We kept saying that retail is dead, and it looked like it was dead. You have online that is taking over everything. Amazon is the new Walmart. Back 20 years ago, people were about Walmart killing all the mom and pop stores. Now it's Amazon killing Walmart and killing everybody. But you have a bifurcated market, at least as far as earnings. You have Sears is heading to the tar pit, it certainly looks like. You have Gap earnings down, but then you have Macy's, Kohl's, and Target that just blew away earnings. So what is going on in retail?
Well, it's very interesting because Amazon is still the strongest in that sector. I mean, they're still making new highs constantly, so everyone's still competing against Amazon. But I've got to tell you, Target came out this week with earnings. They were up. Walmart had earnings the other week. They were up huge overnight, and I like that stock too. So these stores that have the brick and mortars are trying to compete in the store and online with Amazon. Amazon does not have an online store. So if they can compete with them in both arenas, the Walmarts and the Targets can go up against these people. The JCPenney's and the Sears, unfortunately, I mean, those stocks just don't look too great. I think they're out the door. I mean, I don't know.
Michael, I want to ask you about Sears specifically. Once the dinosaur starts heading for the tar pit, it tends to never make a turnaround. They tried with Yahoo, and it was an e-commerce company, obviously. But it seems to me Sears is just hanging on. Is Sears on life support here and will not be around in the next 5 years?
Yeah, well, Eddie Lampert has gone in and he's stripped out all the good assets for his hedge fund. I don't, Sears' days are clearly numbered at this point.
Do you think Eddie Lampert ruined it?
Sounds
like you said that.
He brought in some really smart guys to turn it around, 12 to 15 years ago, maybe even a little bit longer at this point. And then none of them stuck around. He didn't want to pay these guys. And then slowly but surely, it's been like the Dutch boy sticking his fingers in the holes of the dike. Like, it's just been one problem after another. And then with Amazon coming along, the days are clearly numbered for this company.
You have to be innovative. I'll tell you one thing Walmart's done, and this is really recent, and it was before the earnings came out. You can go and online and buy furniture and put it in a room like a 3D virtual. Like if I want to go buy furniture for a living room, that's pretty cool. So you have to be innovative if you're going to compete against Amazon. And Sears and JCPenney have not been innovative enough to compete.
Well, I want to ask you about somebody that is incredibly innovative, and that is Netflix. And Netflix has the best predictive software there is. That's one of the reasons for their success. They have not been able to get replicated, despite the fact that a lot of these companies have some incredible AI scientists working on this stuff. But the model doesn't necessarily make sense to me. I get the fact that they have this incredible content, they have incredible predictive software, but you have incredible competition right now coming from Amazon, coming from Apple, and coming from everybody in the world now streaming. Netflix is at a new high. Does Netflix continue on this bull run?
I really like Netflix as a long. Now, it failed in the earnings. I wouldn't necessarily buy in here, but looking at the market ahead, I'm bullish on the market. So Netflix is still in the uptrend, even though it crashed on the earnings. I still think it can make new highs, like you said. What I do like, though, I think the strongest point is Netflix as far as they're creating their own content. In other words, if you want to watch show ABC, you must subscribe or you won't get it. That's the only way you can see that show. And once you're in and you've got it and you're in love with that show, when you have a favorite show, whatever the show is, like this show, you want to watch it every night. You don't want to miss it. And so that is something, they're ahead of the game with Apple with that. They're ahead of the game with these other companies. And that's why Disney is trying to do more of that, too. And that's why Disney now pulled back, and they're going to be doing their own content and putting it out even more in a special way where you must subscribe to that specific channel online and on TV to get it. And that is one of the reasons I like Netflix. I know the model as far as the profitability, you look at that and say, well, this doesn't make any sense. But look at what the stock has done. It split, and now it's halfway up again behind where it was even before it split, whenever that was 3 years ago.
Michael, what worries you? I mean, there's a lot of people out there with incredible optimism. There's also people on the other side that says we need to get a bunker and canned food and go hide from the coming apocalypse out there. This is the longest bull market in history. What worries you? Is it a presidential alleged payoff to a porn star? Is it inflation? Is it the House turning to the Democrats? Is it the trade war? What out there worries you?
You know what? If something bad is going to happen or something's going to turn this market, it's something we don't know about. One of the reasons I think retail is taking off is that since November of 2016, you've seen a remarkable turnaround on the people of the lower end of the labor scale, meaning those with less than a high school education or only a high school education. The unemployment rate for people with a high school education or less has basically been cut in half over the last 3 years. And what's not talked about is when you look at wage growth, when you add not only average hourly earnings, when you add additional hours worked, plus one-time bonuses, average hourly earnings are up about 5%. What we hear about is this consumer debt bubble. I can tell you right now, this consumer debt bubble simply does not exist. When you look at debt to assets, it's at the lowest level in 30 years. And when you look at debt service to disposable income, so the percentage of after-tax money it takes to service the consumer debt, it's also at the lowest level in 30 years.
Well, I do think a lot of people are still in debt,
for the
though.
next level of growth.
It sounds like you're very bullish, Michael.
Extremely.